Good day and welcome to another panel. My name is Xavier Borja. Welcome to Venture Capital TV. Here, as usual, I'm together with two great panelists, Vandana and Tushar. Welcome to the show. Thank you very much for joining us once again.
Thank you
We're
so much,
looking,
Xavier, for having us.
we're very much looking for your insights of this interesting topic. But just before we move on to that, I'd just like to remind our viewers that, as you can see in the previous shows, you always have like a little bit of an intro. And in this occasion, I just want to remind you that you can see this show and previous shows. You go to latalkin.com/VCTV/shows. Also, you can follow us on our socials like Facebook, Twitter, YouTube. Just hit the subscribe button, and you always be informed with the latest news, trends, and even giveaways. As before we move on to the show, just another reminder: anything mentioned here is not any type of financial advice. Please do your research before you make any decision. The choices are yours. Well, having said that, then I think we can start. And today's show is about how to calculate the valuation of your startup. And before that, I would appreciate if our panelists can give us a short introduction about themselves. Vandana, would you like to start, please?
Uh, so hi everyone. First of all, thank you for having me here. It's a pleasure to meet you, Xavier, for the first time. And it's my pleasure to be on Latokan VCTV. Thank you to the entire team of Latokan VCTV for creating these shows that helps people connect globally over one platform. Coming to the introduction of myself, I was in Singapore and Jakarta for 15 years in investment banking. And I worked as an investment banker and advisor to family offices and angel investors in Indonesia, helping startups from a diverse background. And after 15 years of staying there, I have come back to India and founded Convanto, which is one of the most well known boutique investment banks led by a female founder in India. I'm also a venture advisor with Loyal VC and a partner with GST Venture Studios. I've also been selected as one of the top most women leaders in the Wealth Management 2021. Apart from this, my brand Convanto comes under the top 10 women entrepreneur brands. I'm connected with 300 plus investors globally. We are sector agnostic. Typically, we do a $1 million to $25 million. My expert opinion is sought in leading business news channels like VCTV and Business World, which can be seen on YouTube. I have given 160 plus talks all over the world. And once again, thank you for having me here. It's a great pleasure to share insights on this panel.
Thank you very much, Vandana, for that introduction. We really honored to have you here. Thank you very much. Tushar, please let us know more about yourself.
Thank you, Xavier. Thank you, VCTV. Thank you, uh, Maria and Hasmik. I'm a founder, CEO of Consultancy Ventures. We are affiliated with more than 350 global investors. I'm also an angel investor in my personal capacity. I've invested in 4 technology companies.
Mhm.
Uh, I'm an accomplished professional with experience spanning multiple sectors. I was part of the team at Brand Capital, which is India's largest venture capital fund by the number of deals they do. I've also been at the private equity practice at Deloitte and Touche, the Big Four consulting firm,
Okay.
and headed treasury at Russian company Systema's India unit. Systema is listed on London Stock Exchange, and I raised almost $2.5 billion for their India unit in 3 years, and was a chief financial officer with the logistics company, which is owned by the American private equity fund Guggenheim Partners. I'm a mentor and judge at 4 out of the top 5 educational institutions in India: the Indian Institute of Technology at Mumbai, Delhi, Chennai, Kharagpur, and IIT ISM Dhanbad. Um, I've arranged funding for startups and growth stage companies in diverse sectors like education technology, fintech, consumer B2B, B2C, agri-tech, D2C, deep tech, and also non-technology sectors. You are free to check the recommendations on my LinkedIn. There are more than 40 recommendations. My expert opinion is often sought by leading business news channels and publications like CNN, News 18, Venture Capital TV, Business World, Business and Economy, and Digital Market Asia. I'm academically trained from Harvard Business School and also MBA in finance from University of Delhi and in engineering. So thank you so much for having me here.
Oh, perfect. So I think both of your profiles fit perfectly what we want to talk about today, the evaluation of startups. There are a lot of people there uh, having their passion for having their own business. Now, how do we go on evaluating that? Here are a few questions I would like to start with. Let's start with the first one. How to determine the reasonable value of your startup? Vandana, would you like to we start with that one?
Yeah, sure. So, startup valuation is never an exact science, especially for early stage businesses. Factors can include your industry, the current market, your team's credentials, and other surrounding forces that might be taken into account. A startup valuation is the measure of how much investors think your company is worth right now. Now, without years of financial data to rely on, startups and their investors, angels and venture capitalists, have had to rely on more creative ways to substitute for these inputs. In a nutshell, the process goes back to quantifying a bit of basic finance, risk versus
Mhm.
reward. And in startup terminology, it's traction versus market size. Now, as a startup founder, you will invariably face a time when you need to think about the valuation of your company, whether you're pre revenue, post revenue in fundraising mode, or simply granting your employees stock options. You'll need to have a valuation to operate, or off. Of course, in fundraising, setting your valuation will ultimately come down to a negotiation, but it's worth utilizing some best practices to justify your number and gain as much as leverage as possible in these situations. Now, coming to your question, how do you determine the reasonable value of your startup? It's always good to have, some sort of idea about the worth of your startup at any given time. If you're not at an early stage, this often isn't easy. Established businesses have assets, solid metrics, a good customer base, and profits. This means the worth of the company can be easily worked out. Now, as a startup, you might be missing some of these key factors, which makes calculating the value of your startup a little bit harder. You also need to factor in your company's growth. Startups are typically high growth business models that are looking to accelerate as fast as possible. Elements like changes in the market, your sales team, and the strength of your product can all come into play when you're trying to predict your growth rate and calculate the value of your startup accordingly. Now, if you're thinking about serious venture capital investments, minor investments applying for startup financing, or looking to get bought out by a bigger player, it's crucial to get the maths right with the right startup valuation method. And anyone looking to invest in your company needs absolute transparency around your financial data before they hand over a cent and get involved with your company. Likewise, you don't want to find you've made a critical mistake in, valuation. That means you're out of pocket in the, uh, long term. Long term, you don't have you're out of pocket. And then there are multiple startup valuation methods you can use to establish pricing based on the type of company and the phase of growth it is in. So I think this is what I would like to suggest everybody.
And, and do you believe then that a startup they can make this valuation themselves, or they have to actually hire somebody professional to do it for them?
I think, when it comes to pitch deck making and financial modeling and business plans, uh, we are professionals in making those. I think they must hire professionals because we understand what the investors actually want, how to create these valuable documents that
Hmm.
will help them seek the right kind of investments.
Okay, perfect. Tushar, thank you very much, Vandana. Tushar, what do you like to add on this, please?
Yeah, I mean, see, valuation. I've been part of Deloitte and Touche, which is top four
Yeah.
consulting firm in the world, and I have personally done valuations for I think more than 35 companies. So basically, valuation is an art. So it is not the same for every sector. It is not the same for every company. So uh, we when it comes to startups, what we primarily do is we make projections for 5 years, and then we say
Hmm.
that the next 5 years, this is the revenue the company will do, this is the operating profit, and this is the profit, net profit, and this much money is required to get the company from today to this kind of future projection. And basis that, we estimate the free cash flows available to the company in the next 5 years.
Hmm.
And then and then using cost of capital, cost of money, we calculate the present value of those cash flows. So this methodology is called discounted cash flow. It is the it is a very good methodology for startups because it factors in future developments, future potential of the company. And
Okay.
it's not the same for every company. So if it is a financial sector company, people are investing money through the company, the company is investing money in stock markets, then of course it will be valued more on the amount of funds under management, the assets of the company. So then we will keep in mind a net asset value, NAV.
Hmm.
So
Hmm.
yeah, and then if we have a company which has a comparable competitor which is listed on the stock exchange, so we will make use of the valuation of the stock exchange, the company on the stock exchange, and then basis our business performance, create a value around, estimate value around our company. So all these methodologies are there. There is another methodology which is called transaction multiples. So uh, if suppose I have to estimate the value of my company, I will see which kind of equity transactions have happened in similar type of companies, and what is the valuation at which those transactions have happened, and then I will
Hmm.
try and estimate my company's value. It is called transaction multiples. So all these
Okay.
methodologies are available, but the best one, which I feel, is market multiples and discounted cash flow (DCF).
And just Tushar, just personal question: how long does it take you to make evaluation of a startup, in time wise? How much time do you think?
See, working on the sheet does not take me long time, but arranging data, because if you want to find market information which is available in the public domain about comparable listed companies or comparable transactions, then all these data is usually not easily available in the public domain. So
Hmm.
you need access to databases, you need access to Bloomberg, to Reuters, to Capitaline, or you need access to all those databases which whose professional job is to arrange this data and have this data with them. So that is why we make use of all these databases, get the data. Once the data is in hand, it takes like 3 to 4 hours to but because it is an art, so you need to study a lot about it. So usually when anybody gives us a mandate for doing the valuation, we take around 7 to 14 days. So between 1 or 2 weeks we are able to give back the valuation.
Okay, 7 to 14 days. There you have it, guys. Thank you. That was just a personal question, but now to move on. Obviously, when having a startup, And having evaluation, people might come up into certain issues, problems, dilemmas. Vandana, what are the common issues that startups face doing evaluation?
So, we are in and out of this market and we see several documents every day. The first major factor is no history. Most startup companies have only 1 or 2 years of data available on operations and financial activity. Valuing such companies early in the life cycle is difficult. Thus, the valuer should understand each aspect of a business plan, and after applying his or her expertise and knowledge of market, the valuer should agree with such business plans. Then comes no revenue or small revenue or loss making. Majority of the startups are more focused on establishing business models, developing client base, product or service market fit, etc. Hence, they have very little or no revenue as against expenses associated with the business establishment, which results in having negative EBITDA. Now, business plan becomes very subjective and can be vulnerable to overconfidence, bias, or over optimistic views of the founder. Then comes the unique product or business model. Having a unique idea in the form of product or service is one of the positive sides of any business. However, there are equal chances that the business may or may not be able to survive the test of commercial success or failure. Sustainability of projections of such businesses model cannot be benchmarked against proven businesses. Further, the valuer cannot use a relative method in absence of comparable company or transaction multiples, and it also becomes difficult to find the sensitive factor, which is the beta factor required in case of DCF method. Now, the fourth comes miscalculation. A miscalculation in either the direction isn't going to cause too many problems for your startups. If you undervalue your startup, any investors are going to get the benefits and more equity in your business. If your valuation is lower than it should be, then you get some hefty funding at an early stage. This could mean losing a lot of equity. In turn, this means you have less equity to offer for any future investors as the value of your company has been diluted. And on the flip side, if you overvalue your startup, it technically means you can raise more funds without losing as much as equity. And the last but not the least, putting a very high valuation, putting an unreasonable sum or on your startup can sometimes attract the wrong kind of investors. That's just in the deal for the dollars and not the health and prosperity of your business. You might also find it difficult to keep inflating the value to attract future funding rounds, and investors entering into partnership with you under the impression that you have high valuation might become increasingly resentful of their decision to do business with you. I think these are some of the factors that one should keep into consideration.
Yes, thank you, Vandana. Tushar, I saw that you were agreeing at the beginning with what Vandana said about the lack of history.
Yeah.
Do you think that's one the most common issue, or have you found other ones?
See, the startup guy will always tell the investor, look at my future. And
Hmm.
the investor will always tell the startup guy, show me what is there on the ground right now.
Hmm.
So this fight is an eternal fight. It will never stop. So, and the startup founder might say they will do $500 million turnover in the next 5 years, but the investor says, let me factor in the risk reward ratio, I mean the risk as well. So
Hmm.
uh, so while it is very exciting to do your valuation on the basis of projected cash flows, but end of the day, every business has some fundamentals. There is a certain pricing which a particular product can command in the market. We are living in competitive times. Technology changes every 3 to 6 months, and Hence, usually what we do is that apart from discounted cash flows, we also try to rely on other methodologies. And Vandana very rightly said, when we are using the free cash flow methodology, which is called discounted cash flow, then we are trying to bring the value of these cash flows over a period of 5 years to current date using a cost of money. Now, even with a thing like a factor like the cost of money, two people might differ. Somebody might say the cost of money for a startup in India is 30%, and somebody might say it is 15%. And just if you use both of them to calculate, the result will be it'll have a huge variance.
Hmm.
So where does that number lie? I mean, so for using this number, we have to rely on the experience, the judgment of the valuer. And my team, we have been working on this since ages. Probably 14 years, and so we really understand how to get out something which makes sense to both the investor and the startup. And it doesn't help that a lot of articles which are there in the newspapers, on online media, they give you half baked figures. So two articles, somebody would say this deal happened at $100 million, some other article might say it happened at $50 million. Then you are not sure of the information which is available in the public domain. And that is why, see, we are professionals, we have access to best databases, Bloomberg, Reuters,
Hmm.
so we are able to get the best quality information, and then take a decision in this whole process.
Perfect. Thank you very much for that answer. Here's another very interesting question, which me myself I do not know the answer. So as you can see, we are all learning here. What is the difference between pre-money valuation and post-money valuation? Vandana, would you like to take this one, please?
Yeah, sure. So, pre-money and post-money valuations help investors calculate the risk of working with you and the amount they are willing to invest. It's important to distinguish between these two valuation methods when you are looking into an external funding. Now, pre-money valuation refers to the worth of a startup before it receives any external funding or
Hmm.
investments. This gives the investors a clear picture of the current worth of a startup and also the value of any shares that might have been issued. Once a startup has received outside financing and funding rounds, post money valuations can be calculated. These two startups' valuation methods can affect financing and your ownership percentages if you are looking at getting equity investors on board. Now, even if those percentages are small as startups, they could mean a difference of millions of dollars, even if your company goes public further, down the track. So, this is the small difference that I have created between pre-money and post-money valuations.
And when a startup is going to calculate the valuation, do they always calculate do they always have a pre-money valuation and a post-money valuation? Tushar, what do you
So
think?
yeah, so I'll give you an example. Suppose a company, we are saying, I am a startup. I
Yeah.
tell the investor that my valuation is $5 million. So $5 million is a pre-money valuation, because
Mhm.
this valuation is when I have not taken the investor money. So
Yeah.
this is without the investor money, hence it is pre-money valuation. But when the investor money comes in, suppose the investor puts in $2 million. So I had a pre-money valuation of 5 million. The investor put in 2 million. The total is 7 million. So my post-money valuation becomes 7 million. So basically, it's like a valuation before the investor money, and one valuation which is after the investor money. And when I quote a valuation to the investor, I always give them pre-money valuation. That what
Okay
is
then.
the valuation? Yeah.
Okay, then sounds like it is a must to include these two types of valuation when having an overall calculation
Right,
for it.
right. It makes a lot of sense because the investor likes to see a very clear picture.
Okay, perfect, perfect. Okay, thank you. Now I understand. What? Let's move on to the next question. What should be done with a pre-revenue startup? Vandana, can you start, please?
Yeah, sure. Now, in this situation, there are some ways to get a sense of the valuation. The first is the amount. For a Series A round, a typical amount is $3 million to $5 million. So,
Mm-hmm.
given that a venture capitalist often will take a minority position, the valuation of a company usually will be in excess of $10 million. Then comes the timing. If your space is red hot and you have multiple VCs interested in your deal, you should
Yeah.
raise as much as money as possible and negotiate as hard as possible. Bidding wars are common theme in the startup game, but they can fizzle out quickly. And you could just look at prior trends like podcasting and RSS. Now, proof points. Measure key metrics continuously, and setting goals, say on a weekly and monthly basis. If you can show that your startup is making consistent progress, you'll likely get VC's attention. Then comes your team value. If you have a rock star executives and engineers, they actually might have independent value. In some cases, a brilliant engineer can fetch more than a $1 million. Companies like Facebook and Google often acquire companies for their talent, not for their products or customers. Now,
Mm-hmm.
valuation time bombs. Even if you get a sky high valuation, it might be worthless. VCs usually will require liquidation preferences. This means a firm will get back all or even more of its initial investment if the company is sold or liquidated. In other words, if the valuation of the exit is less than the investment amount, your take will be zilch. So these are some of the factors here.
Thank you very much, Vandana, for that. Tushar, would you like to add any other factors?
Yeah, I'll give you an example. Uh, so there is no revenue of the company, right?
Yeah.
Uh, I'll give you three examples. So there is a company which came to me, which is which has formulations which have intellectual property,
Mm-hmm.
and that those formulations are 100% organic. They are as per the European certification EcoCert Cosmos V3 certification. Now they have no revenue, but they have the formulations for beauty products, for men's grooming products, and for children products.
Mm-hmm.
And they were valued at $4 billion. Now, how
Wow.
you it's zero revenue, no production on the ground, no manufacturing on the ground. The company was valued at $4 million because they had the intellectual property which has a value in the market, and
Mm-hmm.
they're they are well positioned to earn money as quickly as possible because they have the formulation, they have the manufacturer agreement, they have the agreements with 28 distributors including the largest distributor in UAE, and they have all that paperwork which is you can easily see that the moment you put in money, in 4 months it starts generating revenue. And
Mm-hmm.
secondly, you
Mm-hmm.
look at there is a New York based startup called Thrasio. It has already become a unicorn. They buy out sellers of products on Amazon and Flipkart. Now there is an Indian startup called 10 Club. When they raised their seed round, they raised $40 million in seed capital. Now you see, without revenue. So some startup founders ask me, they raise $40 million, why can't we raise $100 million? You can very well raise $100 million, but the investor, what did the investor see in 10 Club that he put in $40 million of seed capital? 10 Club had gone to sellers of products on Amazon and Flipkart and other e-commerce sites got letters of intent signed that the seller will sell his company to 10 Club, and they had letters worth $15 million. So the investor thought, the moment I put in money in this, within first 6 months to 1 year, at least $15 million worth of business will get transacted. And because the valuation of the company runs in multiples of profit and loss, of revenue
Mhm.
and operating profit, so naturally the investors 40 million becomes 400 million in 1 year. So uh, so you have to see, in pre-revenue startups, it is not comparing apples, it's about comparing apples with oranges. And you have to have a good and keen understanding of the sector to make out the value which lies pre-revenue. And a lot of investors who are rookies, they actually make mistake. They tend to blindly believe in any valuation which is quoted in the media, and they happen to take wrong decisions. But also, with a pinch of salt, Xavier, I would like to tell you something. There are two companies which came to me, both similar companies, one based out of Bangalore, one based out of Delhi, exactly similar companies. One company raised seed capital at a valuation of uh, uh, 1 million rupees, and the
Mhm.
other company raised seed capital at a valuation of 10 million rupees. Both
Mhm.
similar companies, but the difference in valuation was 10 times. So
What was that due to?
that due to, well, the $1 million company, they approached some corporate friends, and the corporate friend said that there is nothing on the ground. You are starting up, so let us do one thing. Let us keep it at 1 million, and let me pull in some money. The
Mhm.
other person, he approached a very rich angel investor who had tons of money, and he told him that a similar company has been sold for uh, $70 million recently. So the angel investor said, okay, fine, I will put in big money, and hence the valuation was $10 million. So ultimately, there is some subjectivity, and very rightly, why a lot of founders, they want to have higher and higher valuations. But end of the day, it has to be supported by some fundamentals. It cannot be plain projections. That is my advice to a lot of budding entrepreneurs.
Thank you, Tushar. And that is exactly what leads us to the next to the final question. What are the main factors that play a major role in a startup valuation? Vandana, please.
Yeah, sure. So, I have put in four factors here. One
Mm-hmm.
is the profits or the earnings, the amount of money that the startup makes typically before factors like taxes, interest, depreciation, and amortization. Growth rate, the faster revenues and profits are growing, the more valuable. Then the recurring revenue, the greater the percentage of the revenues that's recurring, the more valuable. And then the gross margins, the greater the gross margins, the more the valuable. So I think these are the main factors that play a major role in the startup valuation. um, Apart from this also, how is the team, do they have the drive or no? What is it that they're exactly building? Is it disruptive enough? Are they solving any problem? There are lots of factors that go into a lot of things when we do valuations.
Yeah, that's a really good point because I think, for example, with different tokens out there, some tokens you can see they do have substance in the background. They are going to
Yeah,
help solve a problem, while others exist just for existing.
yeah,
Of course, doesn't mean that they will not have a demand. There's a market for everything, but yeah, in respect to evaluation, I think obviously the ones that have a sound background, a sound project, maybe may be evaluated more. Um, Tushar, what's your opinion?
Once we get into the exercise of startup valuation, then on the profit and loss side, we talk about revenues, projected revenues,
Hmm.
and then the cost, the how much, how will the company, spend the money, the cost, and after revenue and cost, we come to operating profitability. And once we have cash flows coming from operating profits, then we talk about balance sheet issues. Balance sheet issues will be cost of capital, which includes cost of equity and cost of debt. So, India, the cost of debt is more because our interest rates are more. If we talk about US, the cost of debt is hardly 0.5% annual. And cost of equity, US cost of equity is hardly anything because there's so much of money floating around in stock markets and
Hmm.
for investments. But in other countries, the cost of equity might be more. So those are the balance sheet factors. Apart from that, working capital. So, in India, it's a bit of an issue because although the contracts say that within 45 days your money should come from the customer, but sometimes it comes in 60 days or 90 days, which creates a working capital issue with the founders. And
Hmm.
because working capital, it distorts your cash flow negatively. And and then you have this is the information which is within the company. And the second factor is the information which is available in the public domain. What are the similar companies, which are the similar companies, whether in the same country or in abroad, which of them are listed on the stock market, what is the valuation they are commanding vis-a-vis their business performance, and secondly, what kind of transactions have happened which are similar to your company in the market, and third, if you are an asset heavy company, then what is the state of the sector in which you are operating? Is it going down since many years or is it rising since many years? Because projections depend on the cyclicality of the
Hmm.
sector as well. So it is all an art, a lot of art, and there is some fixed methodology. In fact, world's greatest valuation expert is Mr. Ashwath Damodran. And I was happy to have attended his lectures, and it is simply amazing, the way he thinks, the way he justifies, and calculates numbers. It is simply amazing.
Like an art, like you said.
Yeah,
The
absolutely.
form of art. Perfect. Excuse me. Well, thank you very much for that insight. We have reached the end of this session. Vandana Tushar, on behalf of La Token, we really appreciate your time. Thank you very much. For our viewers, remember you can always go back to see this discussion and other discussions. Please go to latalking.com/vctv/shows for much more information. And once again, Vandana, Tushara, a pleasure having you here and having learned so much from you. And thank you very much. Enjoy the weekend. To our viewers, keep safe. You also enjoy the weekend. And until next time,
Thank you so much, Xavier. Thank you, everyone at VCTV. Thanks.
Thank you
thank
too.
you.
It was a pleasure to be here. And I could be reached out on my LinkedIn handle or my website www.convanto.com.
Uh,
Perfect.
I can also be reached out on my LinkedIn handle and my website, consultancy.com, KANSALTANCY. Thank you
Okay.
so much, Xavier, once again.
No, thank you. And to our viewers, again, you have Vandana's, Tushar's names. Please get in contact with them. They will be very glad to hear from you. Okay, once again, have a great weekend and thank you.